Hello. Hello to everyone. Glad to be here. And yeah, let's welcome our speakers for today. Paulius, Simon, Florian, and Ilya. Please take the stage, guys. And while the guys are making themselves comfortable, I will ask you maybe a real question, maybe a rhetorical. Do you know where is the most expensive garbage pile in the world? I can't really see because the lights, but does anyone know? A garbage pile. Where?
Space.
The most valuable. No? Okay, I will tell you. I am betting that most of you know that. You probably have heard the story about this poor, somewhat poor Welsh IT guy who lost about 8,000 bitcoins because he accidentally threw out a hard drive with his key, right? Everybody knows that. So he was searching for about 13, 12 years in the garbage pile of, let me check it, in a Welsh city, Newport. So if somebody wants to get around about 1 billion worth of bitcoins, you know where to look, right? And this story in general is about custody, right? Because he lost custody of his own bitcoins. And that's the story that we will discuss here today because it is at the key of, I think, digital asset future because we need a way to be certain that, well, I mean, who knows? We can always throw out our HDDs and lose our custody of our bitcoins, but we need a way to be sure because when people are talking about their money, when they are talking about their assets, they need to be secure. Also from their own accidents and also from, of course, hackers and all other crypto threats and cyber threats. So let's start to talk about this. Okay, so what is the status quo now with digital asset custody in Europe? I don't know. Let's start with Ilya.
Well, the main status is about MiCA coming into play and the custody becoming more and more institutional, obviously. So I would say we are drifting towards the more CSD approach and assets becoming more and more kind of reliable for end investors in terms of enforceability of the rights and traceability as well. So yeah, it's just in my opinion, a natural progression there.
Florian.
I'm going to start with a little bit of background because I've started buying Bitcoin a long time ago. So for me, not your keys, not your crypto is still a thing. But then I started a company that is dealing with retail investors. And anyone in here who has retail customers knows that not your keys, not your crypto thing is too complicated for people to really understand what it means. And your customer support is going to deal with things like, I lost my key, how can I get my money back? You're the platform that's giving me the access, so surely you can give me the access back because you give the technology. And then I have to explain, no, actually, I'm not keeping your crypto, you're keeping it, I'm just making it visible for you. And that conversation is really difficult to have. And I think at the stage now where we have reached mass adoption, we also have to deal with the consequences of that. And this is why also the regulator stepped in and said, look, you guys, you're obviously providing a service here that feels like you're actually doing a banking job because you're custodying assets. You're saying it's non-custodial and therefore it's the user's responsibility, but also you have a responsibility because you're making it available. So let's regulate that and let's actually introduce laws for you guys of how you have to do that. And so that's why where we are right now is in a space where the rules for us have changed. It's for the protection of the customers because the customers have expectations. But we're still in that space where both worlds exist, right? We have non-custodial, we have custodial, and then there are some believers in both sides, and we're trying to figure out now how do we exist as businesses and what does that mean.
Exactly. And Simon, how do we exist as businesses and as clients?
Yeah, absolutely. So to also piggy off what Florian just said, the responsibilities are growing larger with the retail entering the market, and that is actually also to give a little bit of background on Tangany, what our founders had in mind in 2018 to provide a regulated gateway for retail users to not have to store their own keys under their blanket or whatever, so they could like actually hold it on the platform. And so again, piggybacking off of Florian said, the regulatory structure for this is also very important. And now everyone's talking about MiCA, evidently. But in Germany, we've actually been regulated under the German Banking Act. As a sole crypto custodian, we had to get that license to do the qualified crypto custody in Germany. So we are very, very accustomed to the regulatory requirements. It enabled us to get our PSD2 license within 3 months. So the regulator really keeps track of the custodians. And that enables us to approach banks, to approach traditional brokerage platforms and tell them, look, guys, we have a product that is so regulated and that is so overseen and that takes a lot of complexity away for your retail customers in a white label manner that you don't have to develop all of this yourself. And this is kind of the value proposition that we try to deliver every single time that we work together with a bank.
Mm-hmm, mm-hmm. And Paulius, how do you see the landscape now?
Just in general, if we're talking about custody for securities, we need to investigate what we're tokenizing. If we're talking about traditional finance, you need to find the fit, you need to find the license that covers it. And from our perspective, if we're targeting infrastructure and traditional finance, there's DLT pilot license that we have, and MiFID II brokerage as well, to basically cover all those points. Yeah.
Yeah, and okay, so let's maybe talk about the practicalities of how do we now, you guys, specialists in the field, see the custody, how we secure our data, our keys, our assets, basically. What are the technologies and the ways? Because, yes, the traditional format was you create your crypto wallet or whatever you call this thing, you write down the passcode, and hopefully you don't throw it out. And that's about it. I think we have so many stories. I mean, that Welsh guy story is the most famous one, but I think there are a lot of those. I think Estonian brothers correct me, but I think Estonians have one story like that as well. What is the reality now, and how do we make it the way that people, if they lose their key, they do not lose their whole life savings? So maybe let's go with Simon, but any of you guys chip in where you feel fit.
Yes, for sure. So in general, what we do, let's say there's a bank that wants to enable their retail clients to hold crypto assets. What we do is we don't open or we don't create a wallet for each of those customers, but we do open a single wallet for them, an omnibus wallet or an omnibus vault, and we secure those keys in cloud-based HSM devices, so the keys are never actually exposed. From our perspective, this is the industry standard. It's FIPS 3, level 140, correct me if I'm wrong, not on the cloud platform team. But so yeah, this is what we do, and we do this with numerous cloud providers. Now digital sovereignty is entering the discussion, so it's going to be interesting to see where this leads. But technically speaking, so there is one private key for these wallets, and then on top of that, we utilize MPC mechanisms, so that there is never a single person that can seize funds. There is 4, 6, 8 eyes principles. There's a lot of governance mechanisms involved in the actual operations. When we hire operations managers, we need to do highly extensive background checks. And then, of course, we got audited almost. So for the last 2 years, it's been every single quarter there's been an audit, whether by a partner bank like DWP Bank or Bader Bank in Germany, or the BaFin itself came around and said, okay, guys, we want insight into what you do. And so these governance layers on top of the key security play a very big role in our day-to-day operations to also make sure that even though the key is never actually exposed, there's also no one that can seize the assets within that wallet.
I can add to it, but
Yes.
maybe from a different angle.
Yes, please.
To kind of cover the both. What custody means for us is a little bit different. And the best example I can give you what the DLT license is as well what it covers. Because a lot of people are talking about MiCA now, which the license we don't have, and we don't have it on purpose. It's like, it's not that we can't get it, but we're covering the different point. So the custody for us, let's take traditional stock and traditional token.
Yep.
So traditional stock, you do not actually hold a stock. You hold a record in a database that is being kept by a CSD, and CSD actually has the legal basis to keep that record for you, right? The token, the pure token, is like a bearer item, bearer security, which means that basically if you hold the private key, you're the final owner and you have the ownership of that security. When we talk about tokenized security custody under the DLT regime that we have, is basically mirroring what is CSD has right now. So it's basically, it just happens to be tokenized and then it happens to be on the distributed ledger, but the ownership and the legal requirements are the same as in traditional finance. That means basically we are liable to do the investor protection, AML and such. So it's a little bit different. It's not focusing on the instrument security, it's focusing on the investor security and custody.
Yes.
I'm happy to chip in as well,
Yeah, yeah.
because for us, we also provide wallet technology from non-custodial across all different ranges. And we really look at what does the use case really actually hold in that wallet. And then that defines kind of logic and what you can do with the token, and also whether or how many restrictions we want to put on, how do you actually move your tokens, but then also what can you do with the keys, how much do we force the keys on the user, say if it's a non-custodial setup, but it's for, maybe it's more like a loyalty program where you get some collectibles. There's no point going full-blown custodial wallet for that, because the value of what you're holding is more emotional and it's tied to the business, what they're doing, because you get business rewards, but from a financial perspective it's not the same. So I think it's really important that in this context you think about what is it really that you're actually holding as a token, what's the value and what's the legal implication, and the regulator there in many countries doesn't really understand that yet. I'm in Switzerland, we're lucky, we have clear regulations where the token types are defined, so we know what we can do. If it's a utility token, we can do almost anything we want. And the second, it's the security, then obviously we're in the space that we're talking about right now.
And it's basically who's your end client, meaning, yes, you can sell the infrastructure, let's say, to the bank, but who is the client in the bank that you're actually targeting? So from our perspective, it's like private banking clients. They make the biggest investments and they need a lot of protection. That means you have to look for the legal path, less risky approach to basically tokenizing the instrument.
That's actually a really good point, and I feel like anyone in here who is thinking about starting a business in the custody space, think about who you are marketing to, who is your client, because the client is going to dictate whether you even need to put like an ISO certification on top or whatever. I had a conversation in the floor here today where somebody said they dropped the client because they just realized it's too much hassle to follow all the requirements that they have. So I think especially in the custody space, think about who is your target audience, who are you selling to, and then what do they need.
And I think regulation is not there yet, I would say. It covers, like, we have this DLT, but it's a pilot regime. That means it's a sandbox. And what it gives us is just a playground, basically, to check what the clients need. And if you go to the commercial banks, bigger banks right now, a lot of people underestimate what risk committees are of the commercial banks and how hard it is to actually sell the infrastructure to the bank.
And that's a result of the lack of regulations, because the banks have lawyers, and the lawyers are going to put their name on the line that if it doesn't work out, it's going to be their fault. So they will always go for maximum security, and they will simply impose this, and that, because we're just not sure. And so that's where the regulator can help us and say, actually, guys, this is too much. You only need this much, and you're good to go. And then the lawyers can live with that and work with that.
Ilya, you wanted to say something, I saw it.
I just wanted to add that there is also a certain gray area. Where does the responsibility end? Because if you think about it, under MiCA, they make it very clear that it's not only the custody itself, safekeeping the assets, but also whoever has control over certain operational aspects of the token, right? And in that sense, bringing some international perspective from Dubai, we issue tokens for the Dubai Land Department, which is basically property tokens, real estate. And the government is comfortable with the idea that there is certain operational aspects of the token that allow for the lockup of the token in a certain wallet, the clawbacks of the token. So there is an opportunity for the owner, or if the tokens go missing, to get them back and make the investors full. But then the question is, under MiCA, for example, our company, we are a tech provider. We don't do the safekeeping. There is a separate custody provider. However, since we have the operational access to the token setup, we would be considered and we would have to be licensed, which is still a bit of a gray area. And so it's not only about where is the responsibility starting, but also where does it end, which is something that needs to be defined more clearly.
And those commercial banks, basically, they do not operate in gray areas. The regulation has to be as clear as possible for them to jump in. They cannot, it's quite risky, you know, to take that approach from their side or point of view.
So, but basically, what are the benefits of it? Because one could listen to all of this and say, oh my God, it sounds that now we have so much more responsibility, so much more expenses, so much more bureaucracy. And we know EU here, we love bureaucracy, of course. What are the benefits, of course, because you guys are working in the field, you are selling to the clients certain services, so there must be something there.
The benefit that should be there, and ideally all of us are trying to work on that, is for the end user, and especially in the retail space. So I'm not talking about use cases where a bank is your client, because there you have direct or other kind of access. But if you're really want to think about what is the benefit of all of this, is that retail investors should be more protected and it should be easier. So the UX, and that is a huge, huge difference. If you compare your MetaMask experience compared to a custodial wallet, it's not even a comparison. So as long as it's set up properly and that we are doing a good job with as wallet providers, the end user should be able to hold, trade, and invest much, much easier.
Yeah, and maybe connecting right to that. So I mentioned that we provide custody for banks and trading platforms, but ultimately we also onboard their retail customers. So right now we do the regulated custody via terms and conditions with over 700,000 individuals in the German-speaking area and overall Europe. And so, of course, we think about, okay, how can we enhance security via custody for the banks and platforms? But also, how can we make this more user-friendly for retail? How can we make this more scalable? And it's not necessarily a trade-off. It's something that goes hand in hand together. And so we're API first. You talked about the UX, and this is what we focus on mostly. It needs to be as simple as possible. Abstract that complexity. Because if 7 years ago you would have told someone, please set up a Ethereum wallet, MetaMask, and store keys all safely, they didn't have that many alternatives. Now they do. Now all of these platforms usually work with regulated custodians, and that's a huge benefit from my perspective.
I would also add that there are clear operational benefits that are not only or necessarily for the end user, but rather for the entities themselves. If you think about it, every technological upgrade requires upfront investment, always. And it wouldn't be surprising to you, why would a large bank invest into new security protocols, into new data centers that will give them more security? Because it only makes sense. A government would be investing into different defense programs to improve their security before the things happen, right? We have to think up front. And I can give you a very interesting example here, bringing again from Dubai. As a lot of you know, there is a war going on there right now. And the interesting thing, how blockchain was applied there and helped the government to be upfront on the issue. Amazon data centers went on fire a couple of weeks ago, and they were supporting the majority of banking infrastructure in the whole MENA region. And that essentially made the banking sector crippled for a good couple of days. Only because the operations we were running have been first and foremost on blockchain, we managed to restore the data much faster before the AWS was able to access the data in their data centers after all the fire and water damage. And now it is a very clear case that if you want your data to be secure, you need to invest into blockchain infrastructure to make it proof for whatever is coming and whatever is happening in the current world. And blockchain is actually the solution. So it only makes sense to invest now rather than later.
Okay, yeah, so basically we could frame it as some sort of, like you said, technology that can help us secure our assets, not only digitalize them and somehow divide them into tokens or whatever, like we know that people are doing it for art, for forestry, for, well, basically anything you can dream of, but also a pure, secure benefit.
Make it more robust, absolutely, yes. It is necessary, absolutely, to avoid single points of failure, and blockchain brings that exact value.
Actually, if you don't mind, I think Dubai there is really leading by example, where hopefully other governments will realize that, you know, back in the day we had books, physical books. So there was a fire, then suddenly we didn't know anymore if it was your house or my house because the book where it was written from the government burned down. Now we have AWS. Apparently it's vulnerable as well. So the blockchain there really solves that issue. So I love how, you know, we can see real life that there is a use case to be made, and hopefully this is something that will.
It is the most reliable thing today, exactly. Yeah. Yes, and as the guy said earlier, it is all about the source register, right? For any investor, for any institutional large investor, they care about where their rights are recorded. And if your rights are recorded on a server in a data room somewhere, it can just blow up. How secure are those records? You don't want them to be in one place. Just for the argument, like for the story here, Amazon had 3 fail-safe approach. It was made in such a way that they had one data center, they had second one as a backup, and then if something goes really wrong, there is a third one which is supposed to be always available if the first 2 go out of action, but that was very, very unlikely. 2 of them burned down. So there was only one left that has stored the data, and essentially UAE wasn't that far from losing a large chunk of data for the banking sector. So it only makes us think of how realistically, how reliable are our systems and what blockchain can do to enforce that, to help that, to make us more sustainable and reliable.
And question for Paulius, but like I always say, you can chip in. What are the bottlenecks if the technology is so good and well, you know, secure in a lot of ways? What are the bottlenecks if we talk about clients, big investment banks in Europe and big other like investor broker firms, etc., not switching to this technology? Is it regulation still in some ways, or is it like just the tradition that is keeping them back, or something else?
I think probably all of it in a little bit. I would say compliance, risk, and the business incentive not being enough. Tech layer probably too, but it's like a little bit of a different excuse. For tech, banks changed tech before, like generally for payments. Let's take that example. If the incentive is big enough, the banks can shift quite quickly too, and they have a capability to change the tech. I think the tech right now is still developing a little bit. Maybe more business incentives or commercial products need to pop up. But from my perspective, the risk is a big factor too and very underestimated. That means risk needs to be managed by regulation. And not only regulation, but the banks themselves have to show the initiative to investigate what is the actual risk. Because currently, if you go to the traditional banks, they quite clearly know what happens if Euroclear fails, you know, what steps should I take? This is the compliance for it. They don't really know anything about other licenses. They know just the basics, but going to the risk committees, it's not enough. So I think when the commercial incentive is big enough, the risk evaluation will go and risk committees will check more in depth what is the actual risk, and then it's going to be like a snowball effect. At least that's how I imagine it. One bank will take a risk, another sees that it's actually working quite safe, the customers are happy. We have different interesting products, therefore, banks move on competition, and basically they will, it's going to be this way, at least I hope.
Yeah, I also really want to chip in here because we work with 10 plus-ish banks in Germany, in the DACH region, also some Raiffeisen banks. These are like the traditional players. And I think everything you just said is very accurate, and it could be summed up in just a huge lack of education, a huge lack of knowledge, and not enough skill and talent in these institutions to foster this innovation. So what we offer is custody for a crypto trading platform. This is plain vanilla. This can coexist with core banking systems. What you are talking about, you guys are thinking the whole game entirely new. For stocks, for tokenized securities, equities, and so forth. So that's 2 steps further, I would even say. And until we have that education that makes this accessible and enabled setups where systems like yours are being utilized, I think we're unfortunately still far away, and we need to continue this educational effort.
Yeah, that's why we took the first DLT pilot license initiative.
Right.
We took the legal path. We didn't took the commercial path, basically saying, what is the need of the market? We are looking at the infrastructure and preparing for the future, basically saying, if the banks are changing the infrastructure, this is the license that covers it the best. It's very similar to the traditional finance. Therefore, we are super prepared from the legal perspective. And if the bank approaches us, we have all this work that has been done, all the gray areas we already had to cover in practice. Therefore, it's easier to have a connection with the bank. But yes, it's a little bit future-based, less than Mika, I would say, right now.
Yeah.
But yeah.
I'll just add one more step to this, because it's perfect how you guys said, yeah, it's the risk appetite, it's the regulations, then the education, because you have to actually understand as an organization, like what does that mean for us and how do we do it. And then after that comes the architecture of the tech, because the banks, and I have had insights to that, is not built for, let's just even 24/7 trading. For us it's so obvious, but the banks are like, well, who is going to sit there on the desk? Because we shut down at 5. If something happens, we come back at 9 the next morning. In crypto, that's just not possible. You have to figure out how to solve that. So it sounds like a small problem, but actually say if you're a bank with 10,000 people and processes and operations that are locked in and they're, set in stone almost, to change that takes a lot of education and then the systems and the architecture. I spoke to one bank in Switzerland, and they said that the hardest part for them was just figuring out how they can put a currency into the system that has more than 3 decimals. Again, it sounds like such a small problem, but if you have systems that have been built for fiat currencies and now suddenly there's a new kind of currency that behaves differently, there is a knock-on effect from one system to another, and banks are patchworks of software. Everything is intermingled and somehow connected, and if you change one thing, everybody freaks out. So if you just add a decimal, they're like, whoa, I'm not sure if it's going to work.
But a lot of these issues, I think they can only really be discovered during the process of testing things. So the regulation often tries to work in isolation and solve everything before it goes out in the world, which is not a productive scenario, right? The real innovation should be happening together with the regulator, where there is a strong bond between public and private sector that allows to make mistakes in a confined pilots that are specifically for that, to try things and to inform the regulators, to inform how things should operate, where the danger zones are, and only through trying these things together with the private sector, it would be possible to really define something that would be applicable to the real world, not just an idea somewhere on paper, discussed by lawyers and regulators, but rather actually implemented into the real world.
think what you're saying works really well in a new industry, right? Where there's a lot of startups, there's an active ecosystem, you're trying things out. But now when we talk about banks, their risk appetite to try stuff is really quite low. And I experienced that in Switzerland, where we have the crypto valley, where we have a regulator that was interacting with us and was talking about how do we classify these tokens. That's all gone now. Now it's all about the banks, and the Swiss regulator is actually making it harder now for the crypto industry. Like stable coins, you can't issue them in Switzerland anymore unless you're a bank. So it feels like that kind of, it's gone upside down. And so what you're saying
There is a push
really
and
is how it
pull.
should be.
Yeah, I think there is a push and pull situation. Switzerland was ahead of the world in terms of bringing blockchain into its infrastructure, into institutions, and banks a lot of them have been building quietly, even though publicly they were saying, no, blockchain too dangerous, we don't deal with that, too volatile. But if you look at JP Morgan, Goldman, Deutsche, all of them, the moment regulation becomes clear, all of them suddenly have a product which already exists. And you're like, how is that possible? So you guys were saying that you're not doing anything. They are all building. It is just a matter of them building it for the right moment. And then this is where I think the regulators start feeling a bit of a danger there, because things start moving too quickly. You know, the private sector comes and they're like, we're ready to go. Let's do it. Let's go now. And the regulator like, oh, hold on. Let's go slowly. And this is what creates this friction. And I only think it's natural. It's fine as long as there is a conversation and like everybody's ready to kind of work on this, because otherwise nobody is going to move forward.
And I think it's quite an interesting phenomena that bigger US banks, actually, they are innovators. They're not actually afraid to innovate and do something new. The middle banks are actually, those mid-sized banks are actually the watchers. So they sit back and watch the show. And let's say, you know, if something fails on a big US bank, it's not a big deal, I would say. But for a mid-bank, it could be a big crisis in Europe, for example. So they basically sit back and watch regulations being written. They sit on the table, they see the products, but they wait for the finished product, basically. Mm-hmm. So it's a bit of a phenomenon that the smallest players and the biggest players are trying to move, but those mid-sized are actually just watchers.
Exactly. Basically, the ones who don't have nothing to lose and the ones who can afford to lose. The mid players, they are in the middle. But we are approaching fast the end of our conversation. We could probably talk 2 more hours or the whole day if the panel allowed us. But I would like to ask you all shortly, what do you see the future of digital asset custody, digital asset custodian? Is it going to be integrated, as we talked, in all of those financial institutions as their own separate department, or is it going to be a service they buy or rent from companies like yours and similar providers? Who wants to go? Simon.
Yeah, sure. I mean, this is also very relevant for us as a business, because we want to know where do we want to be in 5 to 10 years. I think there is going to be 2 different categories of custody in the market. I think there's going to be, you already mentioned it, like the large banks, the large institutions that have been quietly working, that see the responsibility to develop these sort of things themselves. I think there's going to be these type of players. In Germany, DZ Bank and DK Bank, so the heads, like the investment players of the large banking conglomerates, they're already doing the custody themselves. They're self-hosting, they've built on top of tech solutions, they've required the licensees, so they don't need a service anymore. So these super large players, they're going to have their own solution in place. Everyone else, I believe there's going to be a list, like let's say 20 to 30 custodians who are each specialized in their own simple thing. Like one custodian is going to have Mika and PSD2. The other custodian might only have PSD2 for stablecoins. The other custodian might only have Mika and serve corporates for remittance. So I think there's going to be a large variety, and every custodian is going to have their own single spot in there.
Okay, so one more. We have countdown, 45 seconds. Who wants to draw in the future for 2030?
I think a lot of the infrastructure that we're building right now is actually going to go into the big players' infrastructure and will essentially wrap itself from inside out, if you want, in the sense that we are replacing banking infrastructure, but the banks will use it at the same time. So it's a big shift. It's sort of like a digitization on the Web3 level, where we're bringing in Web3 technologies into the banks, and the banks will use it, and it's going to be part of your daily operations, and you might not even know it.
Okay. And with that, I will say thank you to all of you. If you guys did not believe that this is probably one of the most important topics for today, I hope that the panel convinced you. This is so important, not just for digital asset future, but it is important for the whole, I would say, European economy, definitely, and probably world, but we here care more about Europe, of course. So thank you. Thank you, guys.
Thank you.